There have been four key developments in the past month in markets, two of which have dominated the headlines, but the other two arguably are of equal, if not greater, importance to market and economic developments in the longer term. First, we've had the continuing Greek saga. Of course, the extraordinary and unpredictable negotiating tactics of Syriza have continued with this surprise calling of a referendum on the terms being offered by creditors. We've now had the referendum, of course, and the only real outcome, frankly, appears to be a serious hardening of the Eurozone's position, and now what appears to be a firm deadline, Sunday the 12th of July, for a final decision on the terms of a renewed bailout programme. In effect, it seems that this is really going to be an in-out decision for Greece and its EU partners on continuing membership of Greece in the euro itself. So, no exaggeration, I think, to say that this is going to be the most important day for the euro since it was launched some 16 years or so ago. In the meantime, Greece is on the brink of an economic disaster. Its banking system is close to shut down. Whichever way the discussions on Sunday go, the prospects for Greece are really miserable. But perhaps the more important question for investors is the impact on the rest of Europe and the financial system generally of an economic collapse and full default by Greece. In this respect, we're in a much better position than if this collapse had occurred 4 years ago. Since then, most banks outside Greece have reduced their exposure to Greek debt to pretty minimal levels. There are no systemic issues now if Greece defaults. The debt is predominantly owned by the Troika, the European Commission, the ECB and the IMF. So there's less damage than would have been caused a few years ago. And economically, Greece accounts for less than 2% of the EU economy. So it doesn't really matter too much. It's not really going to impact on overall growth in Europe or globally. Arguably, the biggest impact, though, would be for the euro project itself. The principle of irreversibility, which has underlaid the currency union from its inception, would be destroyed. So when the next crisis comes along, as it inevitably will, confidence in the union would be diminished, and I think self-fulfilling speculation could then force more exits. So the status of the euro could be permanently damaged by Grexit. But it's interesting, I think, and notable that the euro has remained remarkably stable as we approach this end game of the current phase of the crisis. And in fact, the euro is still about 5% higher than it was earlier this year. It hasn't really sold off in the last couple of weeks of real concerns about a Greek default. Government bond yields across the eurozone, they've only been moderately affected. German bonds, being the safest haven, have indeed rallied. And peripheral markets, Spain, Italy, Portugal, they've sold off. But in neither case have we seen really substantial moves. So far the crisis has had no noticeable impact on Eurozone economic activity, which continues to show modest improvement. Recent data over the past few weeks has confirmed this trend, but there are some risks that a full-scale Greek default will cause a bit of a loss of confidence across the EU. The bill will have to be picked up ultimately largely by the Eurozone partners of Greece. But I think it's going to be a pretty modest and probably short-term impact if there is a negative impact. European stock markets have sold off during this latest phase of the crisis. They're now down about 10% from their peaks of April, although still up by close to 10% so far this year, so no big damage there. At these levels, valuations are, we think, relatively attractive, and we see this sell-off as a tactical buying opportunity. The second key development in the past month has been the collapsing Chinese stock markets. I think this was absolutely bound to happen sooner or later, given that in the previous 12 months the market had risen by 150% and by 60% so far this year in just 6 months. It took valuations to completely unsustainable levels. At the peak in mid-June, the Shanghai market was on a PE of 32 times earnings, 57 times earnings if you exclude the very lowly rated banking sector, whilst the tech-heavy Shenzhen index was on a PE of 85, which is sort of reminiscent of the tech boom on Nasdaq in 2000. So the questions for us were always, when would the bubble burst and how far would it fall? Well, we've now some of the answers to those questions. Since the market peaked 3 weeks ago, it's fallen by 32% in Shanghai, 40% in Shenzhen, having been driven higher by an extraordinary surge in retail buying, much of it on margin and leveraged. There's now been a panic sell-off. On some estimates, margin lending amounts to about $600 billion odd, with other forms of leverage potentially doubling this amount. The authorities, having fueled the rise with cuts in interest rates and easing of monetary policy, which was in turn partly designed to support a slowing economy, are now reacting with some alarm to the plunge in share prices. IPOs have been curtailed, margin lending restrictions eased, securities companies and state institutions have been encouraged to buy stock to stabilise the market. And now an extraordinary move, the latest move, 50% of listed companies in China have now suspended their share price listing. So even if investors wanted to cut their exposure, they're restricted in doing so. There's only half the stocks that are listed that are available to sell. But as with Greece, in the case of China, the key question for investors is the wider ramifications of this collapse in share prices. Since the bubble was created predominantly by domestic investors and most international investors have little or no exposure directly to China, I don't think there's a significant immediate impact. However, the falls could have a negative wealth effect in China. There are now tens of millions of active retail share accounts. It's a fair bet that most buying didn't take place at the low levels of a year ago. And with considerable leverage in use, losses could be pretty substantial. But this needs to be kept in perspective. Equities account for only around 10% or so of household wealth, and consumption generally is a much smaller proportion of the Chinese economy than in developed nations. So on balance, the effect could be to further weaken, but only marginally, the already slowing Chinese economy. The financial system in China has only modest exposure to the stock market. While there will be losses for securities companies and increased stresses in parts of the system, these are not of sufficient size to cause systemic problems, and banks, clearly the biggest and most important part of the financial sector, are estimated to have only about 1 to 2% of assets exposed to the stock market. So there's going to be more than adequate liquidity provided by the central bank, the People's Bank of China, so I don't think any big systemic issues. Perhaps, though, the biggest long-term impact on China will be the loss of confidence, both domestically and internationally, in the proper functioning of China's stock markets. This clumsy attempt by the authorities to arrest the market plunge has called into question their credibility and control over markets. And in turn, I think the reform program and the capital account opening being so carefully planned and managed by China could be stalled or delayed following this extraordinary move. However, it seems that this collapse in China's equity market is mainly a domestic problem. It's unlikely to have a significant impact on the broader Asian or global financial markets. And I think any further sharp falls in Asian markets outside China would be an interesting buying opportunity on a longer-term view. The third issue this month, one which has received really very little attention, perhaps understandably against a background where Greece and China have been so dominant, is the nuclear deal between Iran and the West, which appears to be moving very close to a final agreement. The impact is going to be to open up Iran to closer cooperation with the West and to additional supply of around 1 million barrels of oil per day. Coming onto a market already oversupplied, this has pushed oil prices down by about 10% over the past month. The full impact of this collapse we've seen in oil prices over the past year or so is yet to flow through fully to developed world economies, and I think is going to be a supportive factor for growth over the coming months. Finally, and arguably the most important influence on markets, certainly in the longer term, is the Fed decision on interest rates and the evolution of monetary policy as the US moves away from ultra-loose monetary policy, which has been maintaining now for 6 or 7 years, towards normalization. Data from the US suggests that growth has picked up from the first quarter weather-related drop. The labour market has continued to improve, the housing market remains in good shape, and most forward indicators point to sustainable growth of around 2 to 2.5%. Against this sort of backdrop, the Fed has painted a more upbeat assessment of the economy. It's reaffirmed that any tightening, though, will be gradual and data-dependent, with no mechanical formula. However, the Fed has at the same time lowered its forecasts of where interest rates are going to be at the end of 2016 and 2017 by about 0.25%, so a little bit more dovish to that respect. And its longer-term forecasts are still anchored around 3.5%, so well below the levels reached in previous tightening cycles. The markets are very much focused on the timing of the first interest rate rise, but really whether this takes place in September, December, or even early next year, it's less relevant, I think, than the extent to which the Fed ultimately tightens policy in this cycle. The key risk for markets is if the economy picks up more sharply and inflation becomes more of a threat. But at this stage, against a pretty uncertain global economic backdrop, fairly slow nominal growth around the world, debt levels that still remain historically very high levels. We believe that interest rates in the US will remain well below previous cyclical peaks for many years ahead. It's also very clear that the other two big central banks, the ECB and the Bank of Japan, will maintain their huge QE asset purchase programs for the next year and will keep interest rates at or close to zero for the foreseeable future. So market volatility has increased in recent weeks as these factors play out and the Greek crisis rumbles on. Equity markets, especially in Europe and the UK, have weakened off, and bond markets have seen first a sell-off as the Fed's first interest rate rise looms. Then they've rallied in the safe haven markets as fears over Brexit and default have increased. However, we view these moves as a pretty healthy correction rather than something more sinister. The supportive monetary environment I've talked about will ensure continuing high levels of liquidity globally. And while there are clear risks, none of these appears to be potentially damaging enough to result in a renewed bear market. So this current period of nervousness and consolidation that we're in probably has further to run, but we see an opportunity ahead to add to risk in our portfolios, particularly in equities, where valuations have become more reasonable again in this risk-off period.